the Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the show, everybody. Episode 87. Today, we are going to look into what happens behind the scenes, or I should say when planning to sell a business. More to come with our great guest, but as always, let's take a brief moment and thank our episode sponsor.
This podcast is brought to you by Legacy Lock. If you are new to estate planning or simply need to review your current plan, Legacy Lock makes it as easy as pie. Legacy Lock is a unique platform that enables you to easily complete your attorney-drafted documents conveniently from the comfort of your home or office. Your first step to this peace of mind is simply visiting teachingtaxflow.com/legacy.
Welcome back to the Teaching Tax Flow podcast, everybody. As you read, as I like to say in all of them, hopefully you read the title of the episode, the show description, and everything else that came with it. As mentioned, today we're going to look at those tax and legal considerations when selling a business. So, as we like to say, it's not as easy maybe as selling a house, right? You just don't pop up a sign in the front yard and, people come look at your business and say, hey, you know what? Yes, I want it. Make it an offer. There's obviously more detail that goes into that, as well as some implications on the tax and legal side, obviously. So, Chris Picuro, welcome back, sir. How are you doing today?
I am amazing, John. How are you doing?
I am doing great, man. And this is a topic I know, we say we get excited about all of them. This one I've been looking forward to because I know we get questions around this, and I know for a fact that a lot of people just have questions around this, and they probably, it's not as easy as doing a Google search and finding all the correct answers, because I'm sure every situation is very different, as well as states and really just the type of industry. So I look forward to this one.
Yes, I'm really excited about this episode because we run into situations where people are transitioning a business everywhere from just super small business, almost an unsaleable business, to a very elaborate business. I had a discovery meeting with a potential client that sold his business to an ESOP for about $40 million this week, or the week of this recording. So you just never know what you're going to run into. But very excited. I have a longtime friend, actually a gentleman I went to high school with. So that was only, 10 years ago? I don't know, something like that.
That's as bad as my wife saying she's turning 22 this week. That's a lie.
Oh, John, hey, there you go, John.
Yeah, we know she doesn't listen to this show, like we always say, so I can say anything I want to.
No, our wives,
we stay out of trouble.
They never listen to the show, so we could just throw them under the bus on pretty much every episode. But no, I'm very honored to be joined by Jim Cunningham. And like I said, Jim and I have known each other for many, many years. I absolutely love the way he does business. He is an attorney. He is a partner at Dickinson Wright, which is a large law firm with a ton of capabilities. He works with clients all over the country. He's been, I know he's got a big client base in the Detroit area, here in the Nashville area, and I think he's based in Atlanta area now. And he works with businesses, specifically in the merger and acquisition area, and he does other things with business clients. But we twisted his arm and got him on the podcast. So Jim, welcome to the Teaching Tax Flow podcast.
Thank you, Chris. It's a pleasure to be here. We were just met John here for the first time, and we were reflecting on our friendship and how long it's been. It's really hard to believe that it's been 35 years. So it's a pleasure to join you here, and we're getting older, man. It's good stuff. So happy to be here. This is a topic that has been near and dear to me in my practice for over 23 years now. Buying and selling. Basically, my practice centers around buying and selling assets, businesses, real estate, and then the financing options that go with that. So I've seen a lot. I've been blessed with opportunities to represent many great clients who, like you, some have very large, sophisticated businesses. Some are smaller family businesses. But either way, these are important transactions. And you go through the life cycle of a deal. It's really an amazing thing. And so I'm happy to be here. I look forward to covering this topic and contributing a little bit.
Absolutely. Well, the transition of a business, can be very well thought out, and it can be involuntary. And obviously, from a tax perspective, timing is very, very important. And so we're going to talk today about the difference between an asset sale and a stock sale in general. We're also going to talk about a couple of different ways to structure the business transition, either internally or externally, I guess you could say. And then financing also. Obviously, the more thought out the transition plan is, and just in my experience, the more internal it is, the smoother it is. Versus, my experience, most of it comes within the tax and accounting world. And personally, we've purchased 6 books of businesses, and we sold all of them. I would not buy a book of business anymore in the tax and accounting world, just with the landscape. But that's a different podcast, John. Actually, it is. It's a different podcast we do specifically for tax professionals. But that being said, a couple times we acquired a business from someone that was deceased unexpectedly. We acquired a book of business from someone that was terminally ill. We've acquired a book of business that someone stayed on and transitioned with us. So really, how it's structured can play a role in the success and retention of the client. So, Jim, let me ask this question. At what point in a perfect world, we're not talking about owner got hit by a beer truck or something like that, at what point should a business owner, regardless of size, start thinking about a transition?
Well, good question. And that's how we naturally lead it off. I think, the answer varies depending on the business, the individuals involved, where the business is in a particular life cycle. As you know, Chris, there are certain family-owned businesses where, generation 1 or generation 2, whoever is actively managing and controlling the business, where those generations are looking to pass the business on to, the next generation. And so, those situations are kind of natural family-owned businesses, and you have the benefit and the ability to say, when you're working with a family-owned business, you're working with, let's call it generation 1, and you represent that business. There's always the natural discussion when generation 2 becomes actively involved in the business, whether it's a son or a daughter. They're becoming active, and that's a natural one there. And I'm sure you've seen that a lot, Chris, where you have the ability to plan around it because, everybody knows that, generation 2 is going to take over and run this very successful business. So you have the ability then to kind of plan around the transition there in a smaller family-owned business.
Yeah, I agree. I think that tax and legal considerations are very important, but most importantly, the transition has to work well, or else you have nothing to transition. If it's transition to the wrong people, especially as a lot of times G2 people or second generation people, if they're not actively involved in the business already, they might struggle to be good operators. So depending on that, there's different strategies as far as you can use gifting at times of some of the assets. You can use, depending on the family structure, you could have a sale, you could have where you're selling the assets and then versus selling the stock. I'm going to start real quick before we start diving into more complicated things. From a practical standpoint, Jim, what happens, let's say you have literally a mom and pop shop. Let's say the husband or the male owns a small engine repair machine out of their garage, and he passes away unexpectedly. He doesn't have anyone to succeed. At that point, you really don't have a sellable asset, most likely. Does the spouse kind of just try to sell the equipment? I mean, what makes in your mind a business an actual have some type of enterprise value versus just a job?
Yeah. I think businesses, of course, come in all shapes and sizes. I mean, the value, the business, of course, owns assets, right? So you have the asset value of a business. But as many of you know, if you have a business, you built a reputation, you have some what's commonly known as goodwill. That's really where you have a business going concern that has the ability to kind of continue to grow, and generate income. And so the issue of goodwill, I think, is probably the best. I mean, if you have a couple contracts here and there and some assets, that's all fine and good. But the real enterprise value of a business, I think, is the goodwill and the ability to generate earnings. And so that's how I would I guess phrase it.
Right, and it's how sticky the business is. I mean, if someone's running a small engine repair shop and they have a couple contracts with local power sports companies or dealerships, and then in 2 weeks they could be replaced, you really have no goodwill. You've got some equipment.
That's right. And I think one thing that I want to mention as part of this discussion, my initial remarks were focused on kind of the family-owned business where you have multiple generations. The other sales that you see that's a transition of the business, right, within the family, so to speak. The other sales that you more commonly see are, so-and-so has a family business and they're going to sell it to a third party. The question is, how does that come about? In my experience, we've seen it really one of two ways. Either the business owner is approached by a competitor, someone who's strategically in the market and is looking to scale up, if you will. Like you mentioned, you bought books of business. And so as part of that, you may have approached some of those firms and started a dialogue about, hey, would you like to sell your business? I mean, that that kind of happens naturally and organically. And oftentimes that may not necessarily come as a surprise, but it may be somewhat unexpected for that business owner. So, you're always then, if you have a client who is interested in selling their business and has been approached by a competitor, then you kind of have to really start from scratch, right? Because it was kind of an unexpected sale proposal. The other situation is one where the business is, you have a business owner who's established a business. Their earnings are, they've grown their earnings substantially. They know that they can have an exit and they want to monetize on that exit. So they're planning to move forward with the sale process. And many times clients will come to you in that situation, and because they're anticipating an exit, they have an opportunity to plan, get their legal docs cleaned up, make sure that earnings look as good as they can look, perhaps engage an investment banker to help go out and market the business, to sell the business. And so, in those situations, as a lawyer, you have an opportunity, and as a tax advisor, we would work together to say, okay, client A wants to exit this business next year. Let's get our house in order. Let's clean everything up so that when we go to market, we can maximize the value of this business. So I'm sure you've seen that in your practice.
Absolutely. You've got, in having as clean of books as you can have, the larger the business, the more due diligence that's going to occur. And that's human nature. So let's do this. Let's assume Jim and I are at first advising a seller of a business, and that seller is considering selling his or her book of business either as an asset sale or a stock sale. They're also considering carrying the note, which we could chat about. Jim, I'll start with you. From a legal 30,000-foot legal consideration, sellers saying, what are my, again, every situation is different, but what are my pluses and minuses of either carrying the note, one, and then designing it as an asset versus stock sale?
Yeah. So if we have a client, Chris, you and I are working with a client and we're determining structure, the asset versus stock sale, I would say 9 out of 10 times you see asset deals from a legal perspective. As you know, the tax strategy, of course, often drives the structuring of the transaction. But from a legal perspective, nearly all buyers will prefer, and again, just from a purely legal perspective, nearly all buyers will prefer to do an asset sale for liability reasons. Because when you just to think about it very simply, when you buy the stock of a business, you are taking on that business as it is, and with all of its warts, if you will, whatever liabilities are out there on the books, you're taking that business over as a stock buyer. Whereas if the deal is structured as an asset sale, as a buyer, you are often forming a new entity, and you are acquiring the assets from the selling entity. And because of that, from a legal perspective, as a buyer, you generally are you're better off, because let's say there are unexpected liabilities that this business has. As a buyer of assets, you don't necessarily assume those liabilities. You only assume the liabilities that you specifically agree to assume. So oftentimes, Chris, the deals are asset deals. Now, there are times when we do stock sales. I don't see it as much, but it certainly does happen if there are reasons. I actually had a deal that we closed last year, a flooring company, and it's family-owned business. And for a variety of reasons, it was better to do a stock sale. And so we structured it that way. And as you know, and I know you're going to chime in on the tax implications, but the tax issues in a stock versus asset are, like I said, they drive the train often.
Right. From the seller perspective, typically it doesn't matter too much between asset and stock. A lot of it depends on how you allocate the purchase price of the assets and if there's depreciation recapture. In general, a stock sale is going to be better for a seller, but it's not terrible to be an asset sale. I would say 9 out of 10 are going to be asset sales. The stock sales I've seen are due to potentially licensing and contracts. I've been in the M&A space, especially with like insurance brokerages. They're appointed with certain carriers or medical professionals where they have these relationships set up that are not very easily transferable. That's where a lot of times that drives that enterprise value. From the seller perspective, the advantage of carrying the note is that you get to spread the gain over time, which is really attractive. But if the seller deeds that cash immediately, that's where, you're going to be, in general, paying tax on whatever the capital gain is based on the cash you receive. If you have a seller that doesn't need the cash immediately, then a seller finance note is potentially an option for the seller, although the seller is taking some risk on financing this. They do not want to take the business back. Or you can engage in a more complicated transaction called a deferred sales trust, where you basically create a trust that the seller sells their assets to a trust, and then the trust ultimately sells it to the buyer. So that creates the advantage of that is that the seller now gets capital installment sale treatment, and even if the buyer is paying cash or getting bank financing. If the seller carries the note and the buyer refinances, then the seller doesn't control when they pay the tax on it. And right now, as we know, we are in a low capital gain rate environment. We have an election coming up here that President Biden has proposed greatly increasing the capital gain rates, which would definitely deflate the values of businesses because of the tax burden. That's how I see it from the seller perspective. Now, from the buyer perspective, I'll jump in and go first. Just on the tax side, if I'm representing the buyer, I would pay a premium to get it to be an asset sale. Now, Jim mentioned the liability issue, right? Why do you want to bring on someone else's liabilities? Of course, it can be. I've seen their money set aside for potential lawsuits or hold harmless agreements in place. But if I'm advising the buyer, the reason you want an asset sale is that the assets you purchase are depreciable assets, or you can amortize them. So like goodwill, that's a 15-year asset that you're going to write off straight line over 15 years. But if I'm buying real estate, if I'm buying equipment, a lot of those assets are eligible for bonus depreciation, which we've talked about on the show. And you can get a significant downstroke as far as a immediate depreciation deduction. Sometimes that depreciation deduction is more than the cash you even lay out if you're doing seller financing or using an SBA loan. So in general, for the buyer, I'm going to want them to to push towards the asset sale. Jim, what are your thoughts when advising the buyer?
Yeah. So again, from a legal perspective, agreed wholeheartedly. As a buyer, in order to insulate liability, an asset sale is typically the best way to go. You hit the nail on the head. In certain businesses, you end up doing a stock deal for reasons like, issues transferring license requirements, etc. So I would say really 9 out of 10 times you're going to see an asset sale structured that way. Did want to mention something about the seller note financing piece. From a legal perspective, of course, there's the financial consideration, whether you need the cash now or whether you're okay with carrying the note. I think from our perspective, on the seller side, if you are going to operate with a seller note, the important thing you would want from a legal perspective would be security for that note. So if you're gonna finance the deal, it may make sense and it may make financial sense. You want to protect yourself, and you would want to have a pledge of really anything you sell. So if you're selling assets, you would want to have a pledge of those assets. And you would also want to have a pledge of the equity of that new company, so that if there is a default, that's the obvious risk. There's a default here. And you would want the ability, not that it's a great answer because you're selling your business for a reason, you don't necessarily want it back, but if there's a default, you want the ability to take it back and protect yourself.
And do you see, sometimes on some of these, I wouldn't even say larger deals. I mean, when you're selling a business with 200 employees, sometimes the risk is less than in a business with 2 employees, right? Because one employee isn't as integral in every piece of the business, I would say, in general. But especially for maybe like a smaller, like a 4 or 5 employee business. Do you see it ever when there's a seller note? Do you ever see it collateralized by maybe life insurance or assignment of some life insurance proceeds?
I have seen that. Absolutely. Yeah. I mean, in a business, if there is a key man or woman situation, then you would see that. The key as the seller, the key is, look, you're effectively financing, at least in part, this acquisition for the buyer. Putting the financial terms aside, if there is if you want to get paid first, but if you're not getting paid, you want to be able to take that business back, and then who knows? I mean, down the road, sell it again or grow it. Moving forward. I mean, there are countless stories in that, and for example, the Dan Gilbert's business. I mean, he famously sold that business way back in the day when it was Quicken Loans, and then he ended up. It wasn't through a default situation, but he ended up buying that business back and then growing it into what it is today. So you see situations where there is a take back on a business. And so that's the legal point. If you're going to do the note, make sure you get collateral.
Final thing I want to bring up today, which is in this is another dependent situation depends on the situation, but as someone that owns a business and I've transitioned some of mine, it's scary because that control factor. Like you really deeply care about your customers, your clients, your team members. And then there's some people that are kind of like at wit's end and just want to sprint away. So one of the things that, I want, get your opinion on the legal side of it. Depending if I'm working with the seller or buyer, I might have a different opinion, but there's also that human element, the transition. Does the owner stay on in a consulting role for X amount of time? Does the owner get paid? Is the sale price variable based on some type of performance? We see that a lot with insurance agencies. Can you take us through some of the legal considerations? Because, I know, and Jim, I mean, you're at a large firm, but I mean, there in the tax world, there's a lot of people that we all in general do things the right way, but we do things different ways. And the way I might show something on a balance sheet might not be, or the way I classify something might not be a way someone else would. So what are some of the things, to wrap it up, I guess, is the considerations from a transition standpoint. How would you talk to a business owner that's kind of a control freak that wants to stay involved, assuming the seller is okay with it, versus someone that wants to hand over the keys and run far away, go down to the beach and have pina coladas all day.
Yeah, no, it's a great point, and you see it in many transactions. What you're touching on is the issue of control post closing.
That's right.
You often have, and I've seen this many times. You often have businesses where the selling owners, it's been a family business for years and years and years, and so they deeply care about where that company is going to go after the sale. They've worked with their employees for years and years and years. And so it's a difficult thing because a buyer is coming in and paying, top dollar for a business. They want to be able to control that business on a going forward basis. But often the seller wants to stay involved. So you have to kind of juggle that. Usually the issue of the employees that comes up in many family-owned type businesses where it's, hey, I want to sell this business, but, Mary has been working with me for 50 years and I want to make sure she's taken care of. And that makes all the sense in the world. So always something that's negotiated and a little bit delicate and tricky. Chris, you mentioned another thing, post-closing consideration. So what we see more than ever, sales often have earn-out provisions. So there's a purchase price for the business, whatever it might be. And then on a going forward basis, whether it's a year or 2 years, if that company achieves certain milestones and is successful, there's more payment that the owner gets. So it's incentive. And oftentimes, the related issue that you mentioned is you have a selling owner who does stay with the business for a period of time. They want to make sure there's a smooth transition. And oftentimes, yes, they are paid as consultants, but they have a very important stake in the earn-out provisions. So it's in everybody's best interest for that company to be successful post-sale. You see that often, Chris, you run into transactions where you have private equity or what we'll call financial buyers, right? They're buying I'll use the flooring company as an example. They're buying the flooring company, but they don't know anything about flooring, really. They know it's a really successful business and they want to operate it moving forward. So oftentimes it's important to those financial buyers to have, continuity of business and that owner stick around for a while. So Yes, it's important and we see it a lot.
Final question. This will be, can you give everyone 1, 2, maybe 3 tips? Because we're talking about transactions, this is about tax planning and strategy and reducing the tax you pay in your lifetime, this podcast. So what tips, just rule of thumb, easy tips, can you give someone thinking about selling their business in the future that wants to actually add to the enterprise value? And then a couple tips for people that are considering buying a business that have never gone through due diligence, any red flags that they should look out for?
Yeah, so I think on the sell side, if you are someone that has an operating business and you're thinking that you may be interested in selling it, it doesn't have to necessarily be tomorrow, but maybe within the next, 3 to 5 years, something along those lines. I don't think it's ever too early to meet with, someone like you on the financial side, just to talk a little bit about, hey, I'm thinking of selling this business, whether you think that your business would be attractive to a competitor or whether you'd like to go and have an investment banker, market and try to sell the business. I think it would be good to talk to a financial advisor to help understand, the issues around, how will my business be valued? As you know, Chris, oftentimes it comes down to your earnings and what multiple will be applied in a transaction. But a lot of people don't know that naturally. And so I think talking to a financial advisor on the sell side, it's also never too early to talk to the attorney that you may use, or if you don't have one, reach out and say, hey, thinking about selling my business, are there things that I should think about? Of course, on the diligence side, you mentioned, look, a lot of businesses kind of get going and then they run. And sometimes the paperwork isn't necessarily where it needs to be. On the legal side, we can come in and help a company get prepared for a potential sale. So I talk to your tax person, talk to your attorney, and just have a casual conversation on the sell side. On the buy side, I think that, oftentimes the issue is identifying these business opportunities where you want to invest. And so, on the buy side, if you're looking, I think that oftentimes the best course of action would be to try to get in touch with investment bankers, other people in that network that, deal with businesses that, come up for sale often. So I would suggest that would probably be the first place to start. I mean, you can certainly start with an attorney. I'm not terribly helpful until you've identified a business and you say, hey, I like this business. I've been working with my financial advisor and I think we're going to offer X. At that point, that's when you would want to, come talk to me. We could help you get the LOI together and start that acquisition process.
Awesome. Well, you guys finally, I mean, very rarely do I ever shut up for an entire show, but I filled up about two notepads full of random comments here. And Jim, before we forget, if anybody has any specific questions about this, what's the best way that they can go about maybe contacting you or contacting your firm directly?
Yeah, our firm's Dickinson Wright. Quick search, you'll find us there. And we have, don't quote me on this, but probably close to 600 lawyers now. We're a growing firm. We're in a number of states. Don't quote me on it, but it's 13 or 14 different states. And we are a full service firm and cover all practice areas. You should be able to find me there. And then, Chris, I understand that we're going to put some information out so that if people do have questions, please feel free to reach out. Always happy to, talk about this topic. And like I said, it's an important one and one that I'm pretty passionate about.
Awesome. Well, thanks, Jim, for joining us on this. And, it is, as mentioned, I believe, we spoke briefly before we started recording this, is it's nice to see somebody that's known Chris even longer than I have. So as much as me and him banter back and forth, maybe I'll ping you one day and we can get some skeletons in his high closet out on the public.
I'm down for that.
Oh, Lord.
I'm down for that for sure. Just let me know. That's great stuff. It's great
Awesome.
stuff. But yeah, thanks for the invite. This is fun. Pleasure. Chris, I know you do this a lot. This is my first go at it. So audience, please forgive me. I enjoyed it. And thank you both.
Oh, you did amazing. And you could see why we wanted Jim on the podcast. Whenever you hear about an attorney, your accountants come with a certain stigma, CPAs, right? Like, oh, yeah, I'm going to smell like a sandwich from yesterday or a carton of cigarettes, and I'm going to have a coffee stain on my shirt and a pocket protector and be unkempt. But an attorney sometimes, I don't find this, with the ones we work with, but, they come with a certain kind of a stiff stigma. But I think you're extremely practical. And that's among other great attributes. But that's one of the things I really knew that you'd connect with our audience with. So thank you.
Well, thanks, Chris. Thanks. I appreciate it.
You mean, Chris, you're talking about accountants with pocket protectors and coffee stains, and then it's what was it? I can't think of the movie, but Ron Burgundy, right? He goes attorneys. It reminds me of leather-bound books and rich mahogany. But anyways, on that note, gentlemen, both thank you so much for this. I know our audience is going to absolutely love this topic. Again, it's as we mentioned, as we kind of treaded water a little bit here at the beginning, is that we know it's something a lot of people have those questions on. And, even going way back into business school, I think we probably all heard at some point in time, you build to sell, when you go into business. So I think I wouldn't say we discussed a lot of the little topics, I think that, some people don't think about maybe, right? So just going through that process. But I think the important thing to leave on this note is that this probably is not the best thing to take on your own, right? Seek out some professional advice. Really going back to something that I know teaching tax flow, Chris and myself and even various guests have always talked about is building your personal board of directors for yourself, for your business. We're not talking a formalized board necessarily like you hear in a lot of nonprofits and organizations and businesses, but just having those individuals that you could call on, you can lean on for that information. So Jim would probably make a good one of those individuals, as well as Chris yourself. So thank you both again. I know I said it a couple times as we close out here, as I always like to end every show with, we will see you back here next week, same time, different date, but different topic here on the Teaching Tax Flow podcast. Thank you, Jim and Chris, for diving into this one with us. I know we tend to get a little lengthy on some of these topics because they are so interesting. I really do like it how our first episodes way back when, episode maybe like 1 through 15, we really tried to stay about 15 minutes and kind of prided ourselves with that for a while. But then these topics just keep getting so good. The guests are so great. Honestly, we don't even keep track of the time anymore. We just let it roll with minimal editing, believe it or not. So we love doing these. As always, keep the topic interests coming our way. We love them. That's what drives us here at Teaching Tax Flow. And we look forward to seeing, or I should say, you guys hearing everyone again next week. Thank you as always.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.